Well, weaker guidance this holiday season isn't the only headwind on investors' minds. Our next guest says the Fed risks pushing back too hard on rate expectations. Here to discuss is Brian Jacobsen, Annex Wealth Management Chief Economist and Strategist. Thank you for joining us this afternoon. So in terms of what we're seeing from the Fed risking breaking something, because even markets predicting perhaps a little bit too early some of these rate cuts that they're expecting by perhaps June of next year. What do you think people should have top of mind when they think of how the Fed is moving in this period? Because they've been pretty consistent.
Yeah, I think that one of the things that we've heard from the Fed lately, from the Federal Reserve's minutes, was that it was unanimous that they should proceed carefully, which is a nice change from the proceeding recklessly with a lot of the rate hikes. I think that when we see the 10-year Treasury yield below 4.5%, that makes me a little bit nervous that the Fed might change their messaging, because when we were between 4.5% and 5% on the 10-year Treasury, they seemed to actually kind of like that range because financial conditions were tightening, and they thought that the market was doing the Fed's job for it. Now that we're below 4.5%, I think we run the risk of that change in narrative where the Fed might push back on those expectations. Their next meeting is December 13th. I don't think they're going to hike, but I think Chair Powell, when he comes out to speak next week, he might try to open that door again. And that could be a little unsettling for investors as we approach especially the Christmas season.
Brian, as we watch where yields have been trading there, is it about where the rate is or how quickly it has jumped up? I mean, that's one of the things that we saw in between the more recent Fed meetings about sort of the market doing the work for the Fed. But we've seen just as quickly some of those yields pull back.
Well, that's a very good point. And actually, a lot of the evidence suggests that it's not the level of the yields so much as the rate of change of those yields. That's really evident in the housing market. If you find some stability with mortgage rates, pretty much at no matter what level, people can then adapt and adjust to that. When you think that you have a lot of volatility, rates might go up, they might come down. That's what gives people pause. And I think that something similar happens to businesses with investment spending. I've been talking to a lot of business owners, and they just want a little bit of stability with the rates so that can aid them in their long-term planning. When they're sitting there thinking that, well, if I wait 3 months, are rates going to be significantly lower or they're going to be significantly higher? That type of uncertainty really just puts them on pause when it comes to capital spending plans.
And so even when you look at the consumer themselves, obviously we've been tracking a lot of consumer behavior here. Going into the holidays, still continuing to see that caution in a lot of these earnings calls. Who do you think is better positioned when you look at some of the companies out there, some of these ones with, having to push promotions, especially to try, and then you look at what's happening with their margins. Who do you think is better positioned at the moment?
The way that we're positioning things here at Annex on our investment committee is to really look at it company by company. And if you kind of compare and contrast the market reaction to, say, what happens with Dick's Sporting Goods when they were giving good guidance for the holiday season versus somebody like Best Buy or Kohl's who are giving negative guidance. What we kind of like to see in that is if you see an outsized reaction to the downside, then dig in and explore what are their margins actually like, because you were talking about Target earlier. Target is a good example of company that last year, they were really struggling with inventory management, the idea they were going to have to do deep discounting, but then they surprised by having actually their margins expand. And so we actually think that there are some good opportunities in the consumer staples and discretionary area. So within retail broadly, for those companies that have already gone through some of these growing or adjustment pains.
What are some of those names?
Yeah, unfortunately, I can't talk about specific names as far as within client portfolios, but in terms of the general themes, a lot of people were really focused on leisure and hospitality as being the winners. Now it is likely shifting more towards those with that diversified mix of goods, maybe some of the groceries, some of the clothing, household goods, areas like that. So more of that broader spectrum where consumers, no matter what their financial condition, are they going out shopping for others or are they going out shopping for themselves? So those that have that mix are probably going to ride through this. You can probably figure out what some of those names are.
Okay, we'll likely get a better gauge after the end of this weekend. Brian Jacobsen, as always, good to have you on. Appreciate the time.